Hello, everyone. My name is Doug, working with Steiner Business Solutions, and this webinar is going to give you the basics of reading financial statements. Basically, we're going to go over the profit and loss statement and the balance sheet, just explain what they look like, what information you're seeing on them, and the useful information that you can get out of it. So things that you can look for with your business, red flags, things like that that you should be looking for when you do review your financial statements. Hopefully every month you're doing that. First thing I want to go ahead and do is just kind of give you the basics of this Adobe Connect chat. If you've never done this webinar like this, you will see I'm going to share my screen with you. You'll be able to see a picture of me. You'll hopefully hear my voice, and you can give me feedback by, if you look at the top of the screen, you'll see a little man with his hand raised. And if you grab that arrow next to it, you'll see a drop-down menu of different things that you can do to give me feedback. You agree with something, you disagree, if you want to tell me to speak louder or softer or slow down or anything like that. That's one way to give me feedback, is through those things. And the other is the chat screen. All you have to do is just go down and type something into the bottom of the chat screen and hit enter, and it'll show up, and that way you can ask me questions, things like that, as we're going along. That way you can give me feedback. I can't hear you, I can't see you, but hopefully you can hear me. So if everyone will just test, make sure that you can hear me. If you want to go ahead and just go up to the little man at the top and tell me you agree. Just do that, and that way I know that you're hearing me. There we go. All right, so that's basically how this is going to work. Occasionally, I'm going to throw out a little poll question for you guys just to keep you engaged, and so I can get a little more feedback and learn more about you. So here's the first one we're going to do. Just give me an idea. I want to know who out here is actually doing the bookkeeping for their business. Again, so I can get an idea. I know some of you are probably business owners. Some of you are just doing the bookkeeping. Just gives me a little bit of idea who I'm talking to. Okay, cool. Very good. All right, so what I'm going to be using for this illustration is QuickBooks. That's, most small to mid-sized businesses are using QuickBooks these days, and certainly most of our clients are using QuickBooks. So this is the best way for me to illustrate the financial reports that we're talking about. I've got a sample company open in the construction industry. So let's just go ahead and get started. Actually, before I do that, I got another poll I want to see. How many of you are comfortable reading, and not just reading, but understanding a profit and loss statement? Just give me an idea how you feel about it. Are you comfortable with it? Yes, somewhat, not really. Get some feedback. Just get an idea where you guys feel like you are, what level you're at. Okay, great. All right, so let's go ahead and open up a profit and loss statement. What I'm going to do is one with a year-to-date comparison. And we're going to pull up the last month. Just ignore the dates on this. For whatever these sample companies, they're often dated ahead, so their fiscal year is in 2018 for some reason. That's where they're at. But this report here is going to show your current month, or the most recent month that you closed here, and then it's going to give you year-to-date figures on this side for comparison purposes. So the basic idea of the profit and loss statement is it's going to show you all of your revenues for whatever time period you're looking at, and then it's going to show you your expenses. It's going to subtract the expenses out of the revenues, and that's going to give you your net income at the bottom, which hopefully is a positive number. In this case, this month was a negative number for them, so they lost money, but year to date, they're actually doing pretty well with a large positive number of 111,000. So that's what this report is showing you. You will pick a date range. This profit and loss shows you the revenues and the expenses over a certain period of time. So that can be a month, it can be a year, it can be whatever time period you choose. It's going to show you the activity during that time period. So we've got our income up here, and it's going to give you a total of income. In this case, this company only has one income account. They put everything in construction income. You can divide your your revenues into different categories if you want. And if you want to be able to track different revenue streams that you have, that's a good idea so that you can see the performance of those different revenue streams as opposed to lumping it into one big bucket, in this case called construction income. But that's all personal preference. However you want to see it broken out. Some people get a little too carried away and break out into too many categories, in my opinion, and then the report becomes a little too long. A report like this for a small mid-sized business really doesn't need to be more than a page long. If it's more than a page long, you might want to consider whether or not you've got too many general ledger codes than you really need. The next section, so we got income here. The next section is your cost of goods sold. Another name for this is direct costs. So these costs are going to be something that are directly related to the services or the products that you're selling. So typically, the more of that product or service you sell, the more these costs are going to go up, as opposed to your overhead expenses, which on this report are just called expenses. Those are a little more fixed, like your rent, insurance, things like that. That if you don't have more customers this month, or if you do increase your customer base that month, your insurance isn't going to go up, your rent's not going to go up, but your direct costs typically will go up. So that's why they're separated a little bit. You can have your income here, your cost of goods sold. It's going to leave you with a little subtotal here called gross profit, and that's a very important number. A lot of businesses will use that number because you need to make sure you're getting the appropriate gross profit before you even get to your overhead expenses, so that you can cover those overhead expenses. Just like most people will think of the bottom line, the net income, all the way at the bottom. You obviously want to be making money there, but you need to analyze the gross profit as well to make sure that you're making enough money to even cover your expenses. Because once we get down to expenses, you can see all these different categories. Again, QuickBooks anyway will default to certain categories, but you're always able to set up your own, and it doesn't matter what software system you're on. You have to these categories are your GL accounts, or your chart of accounts. This is basically the backbone of your accounting. So you can break these out into whatever you want to, as much detail as you want to as well. Again, you have sub-accounts. You can see there's sub-accounts here underneath car and truck expense. You have 3 different car and truck expenses underneath it. Again, I recommend you don't get too carried away with adding new accounts, because then you'll just have 3 pages of accounts all with very small numbers in them, and that's really not that useful to you, and it's pretty laborious to try to read it. So these are your expenses, and you get all the way down to the bottom. Again, that's your net income amount. So the comparison is month to year to date here is what we're looking at in this report. Again, the gross profit is very important because typically you're going to have a little more control over your cost of goods sold and your direct cost than you will over your overhead costs. There's only so much you can negotiate on your rent or your office supplies or your insurance and that kind of thing. And you do want to pay attention to that because periodically you will negotiate those things. Your lease is going to come up, and then you'll renegotiate or decide you want to move somewhere else. But a lot of times there isn't much you can do to change those costs. Whereas in your direct costs, your labor, your materials that you're purchasing, you might have options to go through different vendors or use different contractors or just renegotiate the agreements that you have there. So that's why it's important to separate these costs from the other costs. So again, what we're comparing here now is the most recent month to year to date. In this case, it's January through November, so we're looking at 1 month versus 11 months. And the reason we want to look at this is, first of all, it's nice to know what your year-to-date number is too. That tells you what you've made to this point in the year. But it's good to have the current month next to it because you can set them side by side. And whereas your revenues or your expenses might not necessarily, in this case, be literally 1/11th of your total cost for the year, it should give you an idea of whether you're on track and whether this was a normal month or whether it was a high month for revenue or low month. And you can see this $100,000 when it was $753 for 11 months, and this 1 month was $100,000. That's a very high month, so there's a lot of revenue for that month. So that's the purpose of this report, and why it can be useful. I'm going to show you a couple of other profit and loss reports. They're all basically going to have the same information as far as revenues and expenses, but it depends on what you're comparing them to as to what kind of information you can get out of that report. So this is month versus year to date. Let's pick another one. Go into profit and loss again. In this case, we're going to go ahead and do year to date. I'm going to back this up to November because I only want full months. Now it's showing me the entire year to date. But when you look up here, at least this, again, this is QuickBooks. The columns is one, it's totaling the whole year. I want to show columns by month. Now it's giving me a separate column for each month with a total at the very end. Now, this is great because it's giving me a whole year's worth of information, but I still have the ability to go look at month by month if I want. And what I can do is look at trends as well. So I can scroll right across my income account here, just go across and see how things went up and down. This particular business, the revenue really is up and down. It goes up and down quite a bit. Some businesses, they make more money. A landscaping business is going to make more money during the middle of the year when it's warm, and they're not going to make as much during the winter. So, whereas other businesses, work pretty much year round, and you would expect maybe some more consistency to the revenues and the expenses. But this is great because I can just scroll across and look for anything that pops out. I can look at March and say, okay, well, that was a really good month. October was really good, and November were really good. Okay, so what made those really good? Did I run some promotion at that time? Did I just happen to have a lot of marketing build up before those months that maybe promoted my business and got more people involved? Or is that just the way my business is? Again, during those times of the year, I typically am better off and bringing in more revenue. So that's what you're seeing here. Same thing with your costs. You would expect to see that your costs are pretty much, your direct costs anyway, are pretty much following your revenues. As the revenues go up, you expect your direct costs to go down. Now, I would look at this right here and say, okay, we had 134,000 in revenue in October and 0 job-related costs. That's unusual. But then I look at the next month, and another good month for revenue, but the job costs are really, really high. So what happened there? I can look into that. That may be easily explainable. If I went back to my November report, I would look at $100,000. I just saw this here, $100,000 in revenue, and 92 in job-related costs with a negative gross profit. That would have me really concerned. But if you look at it in the context of this report, when you put October and November next to each other, I say, okay, well, those kind of even out. If I scroll all the way down to the bottom, I made $110,000 net in October, and then I lost some in November. So it's probably a matter of timing of some of those expenses. The expenses for the revenue that was actually earned in October, those expenses probably didn't come in till November, and that's why those 2 months look unusual. One looks unusually high, and one looks unusually low. But together, they probably kind of work themselves out. Scroll down here, just get down a little bit further, and again, you can scroll across and look for things that look unusual. Some of these expenses, like your gas expense, you expect probably going to stay close to around the same every month. Some expenses like dues and subscriptions may be more periodic. You're not going to see anything, and all of a sudden you see $2,500, that kind of thing. Some may be quarterly instead of monthly, so you'll be able to easily see those come through here. If you had rent and you didn't see a rent expense for 1 month on here, that would raise a flag. Well, what happened? Why didn't we pay rent? Or was it just that you paid? It ended up going in 2 times the next month, that kind of thing. I'd scroll across here and I would say, okay, well, here's officer's labor. This looks pretty normal, and all of a sudden, boom, in August, $79,000. So what happened there? It is officer's labor. It's not your normal payroll. So I don't know, did they get a bonus that month, or did they catch up for maybe a previous year? They didn't have as much salary, so they're catching themselves up. They're having a really good year, and the owner decided to pay himself more. I don't know, but at least this pops out. Now again, when August was coming around, if I was looking at this report in August, I hope I would have recognized it at that point. But if I didn't, and now it's November, I still, by looking at this report, obviously that number really pops out at me, and it makes me want to look into it a little bit more. The great thing about QuickBooks is not all softwares can you do this. If you're looking at the report on the screen, you can just double click it and it'll actually open up that and show you a report of what makes up that number. So that's a great feature in QuickBooks. Not all softwares can do that, and obviously if you printed out the report and you're looking at it on paper, then you can't do that either. But that is a great feature from QuickBooks. You can drill down and start looking right into things. So this is the month-by-month report. This is a great one for me. I love this one. I'm reviewing clients' financials. This is one I always look at, especially if I'm not necessarily involved in the day-to-day work. I look at this because it just gives me a big picture of everything, and being able to look at trends as I'm going across the months is really easy. If I look at just one month by itself, sometimes it's hard to tell if a number looks out of whack, but when you take that 1 month and set it beside a bunch of other months, then it becomes more obvious. Again, for example, that this officer wages is not something that's fishy about that. It's not normal. All right, so that is the month-to-month report. There's one more P&L that I want to go over with you. Another useful one is comparing your current year to the previous year. So we've got year-to-date here. Again, I'm going to back it up a little bit here, so I've got only full months. In QuickBooks, when you do this report, it's going to show you your current year. In this case, I've got year-to-date. Now you can do this month. I could do November of this year versus November of last year if I wanted, if that's something you'd be valuable to you. In this case, I just want year-to-date versus year-to-date last year. And in this case, QuickBooks gives you the dollar change from year to year and the percent change from year to year. And you can go up here and customize these reports and take any of that stuff off. That's a bit much for me. I prefer to just, the percent change is usually a little more useful for me. QuickBooks also, you can resize these columns to make them fit better. So I look at this report and how is this useful to me? All right, again, I'm looking at revenue this year, through this year, the first 11th of this month of this year versus the first 11 months of last year, and I see that I'm up 13.3%. That's good. Again, same information. This revenue number was the same thing that was on one of the other reports, but putting it side by side with the previous year gives me a whole other picture. It tells me something else. So that's great. And I look down here, I'll scroll down. Okay, my cost of goods sold, they're actually down 12.8%. So that's great. Your direct cost, if your revenue can be up 13% and your direct costs are down almost 13%, that's great. And what does that end up giving me? My gross profit is actually up 82%. Now, honestly, the first thing I would say if I saw that is that correct? Because that is unusual. Typically, if your revenue goes up, your costs are going to go up some. You hope that your costs are not going up one for one with your revenue, that the way your business is put together, you can sell more without having to increase some costs, certainly your overhead costs. But this is a bit unusual here to see your revenue go up by 13%, but your gross profit go up by 82%. I mean, that's great. So this would raise some questions. I would follow up more on this and want to know what happened. Again, you see here that your cost of goods sold, your direct cost went down by 13%. Well, how did that happen? Is that real? If that's real, that's great. Did you do something? You renegotiated some materials costs, or you started using some other subcontract labor that's cheaper than what you were using last year? If that's the case, then great. And then you just managed your business really well, and you're seeing the benefits of it right now. If not, if you didn't do something significant like that, then maybe something's wrong. Maybe that's why these numbers are looking so good. And then you get down into your overhead costs, and kind of the same thing. You can see year versus year to see where you've changed. Your advertising costs have gone up 80%. Well, maybe that's why my revenue went up so much, because I'm all over the place advertising and I'm just getting more business. Again, that wouldn't really explain why my costs are down, but at least that can explain why my revenue's up. But you just scroll through here and again look for anything that looks out of whack. Why is my gas or my truck expense up 287%? That seems a little unusual. Gas prices up, that kind of thing. Do I just have more trucks out on the road working for me? Some of the stuff you can explain and easily when you first look at it, and some you're not, and you're going to need to research it a little bit more. Again, these reports are kind of the beginning of research. It gives you a good picture of how your business is doing, but it also should be raising questions that you need to follow up on. Whether you're the bookkeeper and you need to go look at the entries that were made, maybe go back and look at some stuff to see if everything was entered correctly, or if you're the business owner, you're not doing the entries. then you would probably, you should be going to your bookkeeper or your accounting manager and asking them some questions. What happened? Let's try to figure out why this number is so different. That kind of thing. Officer's labor, that can probably easily be explained, but it certainly sticks out like a sore thumb when I'm looking at this report how much it went up from year to year. So that's your profit and loss. Again, the idea with the profit and loss is you're looking at a period of time, and you're looking at the revenues and expenses. The net income, obviously, everybody wants a positive net income, but then again, the more your net income is positive, the more taxes you're going to pay too. So you try to manage it in that way as well. Sometimes you manage your expenses so that you don't have to pay too many taxes. Another thing people get confused sometimes is trying to tie the net income to cash flow. They typically correlate with each other, but they're not going to be one for one. I mean, it's definitely possible that you can have positive net income, but you still had negative cash flow for the month. If you're paying off loans and things like that, if you're taking out personal draws out of the business, those kinds of things are not showing up on your profit and loss statement, but it's still cash going out your door. Or if this is an accrual basis report, meaning all of the revenue is showing based on when you do the invoice to the customer, not when you collect. Well, if your accounts receivable is really high, then your revenue looks great, but you're still cash poor because your customers haven't paid you yet. So again, the net income does not equal cash flow. It's usually correlated with each other, but it doesn't equal. All right, so that's the profit and loss statement. The next thing we're going to move on to is the balance sheet. Typically a little bit more confusing for people. People aren't as comfortable with the balance sheet as they are the profit and loss statement. So let me put the poll out there for that. How comfortable are you guys with the balance sheet versus the profit and loss statement? Yeah, I typically see people not quite as comfortable with this as they are with the profit and loss. And yep, that's kind of what I'm seeing here for the results of the poll. So great. Let's get into that. Go back to QuickBooks, company financial, and we're going to do balance sheet. We're going to look at this fiscal year to date. Back it up to November again. All right, so now what we see on the balance sheet, again, the profit and loss was income minus expenses equals net income. And it was, if you remember, taking a picture of a period of time. The balance sheet, conversely, is actually taking a picture of one specific point in time. So in this case, you can see the report at the top says as of November 30th. So all of these balances you're going to see on this report are as of November 30th. They have nothing to do with January through November. It's just as of November 30th. Here were all my cash balances were in my cash accounts as of that specific time. So what we're looking at here, you got your balance sheet is going to show you all of your assets. And then on the other side of the balance sheet, it's going to have all of your liabilities. And then at the bottom, it's going to take all of your assets, subtract liabilities, and that equals your equity within the company, which basically equals the net value of your company. So that's the net worth of your company, is the equity portion of it. All right, so you got assets. Assets are things that you own or money that people owe you. So for example, the first section here is going to be your checking and savings account, so all of your cash accounts. Then you've got accounts receivable, so these would be either billings to your customers that haven't paid you yet. You've got a security deposit that you put on something, so that's an asset to you because you expect to get that security deposit back at some point. And then you have your fixed assets, all of your property and equipment and things like that you own. Those are your assets. When we go down to your liabilities, these are going to be things that where you owe somebody else money. So you've got your accounts payable. These are all your vendor bills that are outstanding that you haven't paid yet. That's what you owe. Then you've got your credit card bill, same thing. You're going to owe the credit card company that money. You've got down here payroll liabilities, customer deposits. That's where customers have paid you the deposit, so you're going to owe them that money back at some point, or you're going to deduct it off of a future bill, that kind of thing. And then you've got longer term liabilities down here, like a truck loan, any kind of notes payable that you may have. Then again, we get down to the equity, which is equal to your assets minus your liabilities. It's going to equal your retained earnings, and it's primarily built on your net income here and those retained earnings, which are or your net income from previous years. So when I'm looking at the balance sheet report, what I'm looking for are negative numbers, first of all, because that's a big red flag. You really shouldn't see. There are a few occasions where it's okay to have negative numbers, but I'm always looking for a negative number first because that's immediately I want to go look into that. So I see one here for the payroll checking account. I see a negative number. So there may be legitimate reasons for that, and I can give you an example. For a cash account, you might see a negative number on your balance sheet if you have a number of outstanding checks on your bank account in QuickBooks or whatever system you have that have not cleared the bank yet. So that's a reason why this number also might not, equal, probably doesn't equal exactly what your bank statement says, because this does count any outstanding checks that you may have already entered into QuickBooks, but they just haven't cleared yet. So it still is a bit of a red flag. I want to understand what's happening. If I see that negative amount, I want to know why it's negative. I want to go and look. Again, it's very likely that it's outstanding checks, but then I want to look at how many do I have? Because if all those outstanding checks actually clear, and you don't have enough money in the bank, you're going to be in trouble. You're going to overdraw your account. So do I need to put more money in, or are some of those outstanding checks I just need to get rid of? I need to write them off, or I need to contact the person and see if I need to recut the check because I sent it a year ago and it still hasn't cleared. Scroll down, see another negative number here under accumulated depreciation. Now that's completely legitimate. That accumulated depreciation should be a negative number, so it's going to, every year that accumulated depreciation, that negative number becomes higher. Your fixed asset will typically stay the same based on what you purchased it as, but as you depreciate the value of that asset over time, this negative number becomes greater and greater, which means your total fixed assets will go down and down over the years unless you're buying new fixed assets. Then we go down to credit cards. So this is another negative number. That would be a concern for me. I mean, typically your credit card balance should not be negative, right? The only time it really would be is if you had paid your credit card company too much money. You'd overpaid the bill and actually have a credit balance with them, but that doesn't usually happen. So I would look into this and say, okay, what happened? Do I have maybe payments that were recorded in QuickBooks, but the expense part of it is not there? Because every time you book a credit card expense, it's going to make this balance go up into the positive, and every time you book a payment, it's going to make it go down. So do I have expenses that I haven't booked into QuickBooks yet, and that's why it's there? Or do I have duplicate payments? I booked the payment twice accidentally, and so it put me into a negative balance. It's definitely something I would want to look into. And everything else here looks pretty good. So this is just showing me as of one point in time. Now, similarly to the P&L report, we can do a previous year comparison. If I go in QuickBooks, I can customize it here, add a previous year column and the percent change, and now I'm seeing year to year these balances. This is as of November 30th this year, and this is as of November 30th last year. So I can see my cash account is up from 291 to 353 last year. I see my accounts receivable were nothing last year, and they've jumped up. So again, you can kind of look at trends here and see where your position is compared to last year. Accounts receivable is a good example of something you want to monitor. If it's getting too high compared to your revenue, then you need to do a better job of collecting money from your customers. Again, it's going to become a cash flow issue. You can bill your customers all you want, but if they don't pay you, or if they're paying you late, then that's going to probably cause you cash flow problems. So you monitor this accounts receivable number and make sure it's not getting out of hand. Your fixed assets, again, they're typically not going to change too much, and unless you're purchasing new ones every year, actually this balance will probably go down. Accounts payable, you monitor it year to year, how much you owe people at the end of last year versus how much you owe them this year. Putting them side by side like this gives you a good picture, just like the P&L, from year to year. Again, you can take a piece of information, and if it's standing alone by itself, it tells you some things, But when you put it next to some other numbers, like last year or previous month or year-to-date numbers, then they can tell you a whole nother picture. It just gives you a whole nother perspective on what you're looking at. You can look at equity down here. Say, okay, last year my net equity was 204,000. This year it's 305. Now that's great. That's obviously great news. And you can see your net income last year was 59,000, and this year it's 111. So that's a big part of it. But obviously, that's what you want to see. You want to see the net worth of your company growing. So these are really good numbers. That's what you want to see. And again, looking at these reports, some of these things you can explain as you're looking at them. Other times, it's just going to start the questioning process. It's going to come up with questions that you need to research and find the answers to. And that is work, but that's what it means to actually run your business and manage it properly so that you have an idea what's going on. And then that these numbers are good if you ever need to take them to a bank or an investor or something like that. You want to know you have good numbers. You want to be able to analyze these numbers and know what you're looking at for your own business purposes. All right, so that's profit and loss and balance sheet. Those are the basic ones. Obviously, there are lots of other reports. You've got accounts receivable reports, AP reports, cash flow reports. For certain businesses, you get into job costing, construction business like this. Job costing reports are very valuable. They can actually show you basically a profit and loss statement for a specific job, so you can see all the revenues and expenses just for that job as opposed to seeing it for the whole business. So there are a lot of other reports, but these are the main ones, and these I encourage every business owner and bookkeeper to review these. Again, even if you're not the business owner, this is a great report for you to review if you're the bookkeeper to make sure that everything looks right when you're done before it even gets to your boss. Especially the profit and loss by month. You entered all these charges throughout the month, and you're done. You've reconciled everything. Pull this month by month report up and make sure this month looks like it looks appropriate compared to the other months. If something big is sticking out, maybe you go look into that number first before you even turn this over to your boss. So if there was a mistake, you can fix it before they even see it. All right, so that's pretty much it. I love doing this kind of stuff. And here we at Steiner Business Solutions are always looking to educate people. We're happy to do this kind of free stuff for everybody, and we want to do more. I encourage you to go check out our YouTube page. We have lots of QuickBooks videos out there. I try to put out a couple of especially QuickBooks tips. I'm starting to do a little bit more bookkeeping tips as well. But they're out there. There's no charge for those. If you go there, you can subscribe to our page, and you'll be the first to get notified whenever I put a new one out there. Some of them are on our website as well. You can follow us on LinkedIn, Facebook, Twitter. But we always want to get feedback from you guys as far as what other topics you would like to see, either a webinar like this on, or just the videos out on, on YouTube are typically around 3 to 5 minutes. They're real short videos, so you can go watch those on demand whenever you like. And there's a lot of useful information on those. I know we get thousands of hits on those every month, so people are finding value in those. And then every now and then we do a webinar like this every month or two to hit a little topic that needs a little bit more time and can be a little bit more interactive. So reports on QuickBooks, I see that tip or that suggestion. Yep, we can do that. So I don't know if you guys have any other questions. Now's the time to ask me. Feel free. Otherwise, I appreciate you coming out. Like I said, follow us on YouTube, Twitter, LinkedIn, Facebook. We're always trying to put out information, even tips and articles that we come across that we think our clients would find helpful. We're always posting them on LinkedIn and places like that. And we'll be doing more videos like this. If you're on our newsletter list, we'll certainly be letting you know whenever we have a new webinar coming out. So you can always check out our website and see if we have a new webinar coming up in the future too. So